A lot has happened this week. We're first going to talk about the Bitcoin to gold ratio. The triple top is holding so far at about 36 ounces of gold per Bitcoin. As of this week, all of the second wind of quantitative easing undertaken from 2020 to 2022 has been reversed. From an open interest perspective, it looks like gold and silver have bottomed. We are at open interest levels where previous bottoms have formed these past 2 years. We have a reverse repo update. We are in the new month of December, but we have not seen the registered fall in reverse repos yet. That should come out on Monday, and the average has been about $90 billion, so it should be down to about $100 billion in reverse repos by this week, and hopefully I'm praying that they zero out before the end of the year, though we'll see about that. And of course, once they do zero out, we are in danger of an imminent banking crisis or some kind of repo crisis or something going on in the back end. Nobody knows exactly what it's going to be, but it's going to be rough whenever it hits.
In today's news recap, silver price continues to see buyers on dips. The silver market continues to see a lot of buying overall as the trend continues to see a lot of pressures to the upside. At this point in time, the market looks as if it is trying to find its way higher yet again. The silver market found itself a bit noisy during the early hours on Monday as we pulled back towards the $30 level again, only to turn around and show signs of life. At this juncture, the market is hanging around between the 200-day EMA below and the 50-day EMA above. With that being said, I think we are in that sweet spot where you attract a lot of attention. The question, of course, is which direction do we go? In noisy patterns like this, it's best to pay close attention to the longer term trend, as typically consolidation will lead to some type of continuation. Well, as traders, we have to come up with something, and I think a move above the $31.50 level gives me much more confidence in the silver market, as we will have just formed a so-called W pattern. If we turn around and break down below the lows of the last couple of days and then the 200-day EMA, you could see silver fall apart. Ultimately, we are in an uptrend. So understand that you are still looking for cheap silver to take advantage of, as the market has been so decidedly bullish for the entire year, really. If we do break out to the upside, I suspect we will eventually try to get to the 35 level above. If we can get above that level, then we're off to the races, as the market could very well see continued momentum building in this market. Now, we'll show you more clips, but first, check the pinned comment, especially if you're a stacker, as we have a massive Black Friday deal that every stacker should take advantage of. And hit the like and subscribe button so you do not miss out our recaps. Enjoy the episode.
The Bitcoin to gold ratio holds the triple top so far. It's been week number 3 with gold to Bitcoin at about 36 ounces and change. This is so far holding a triple top that is apparent since 2021. The all-time high is still in October 2021. We have not broken it out yet. If this triple top holds, triple tops are nasty patterns, especially for bulls. They are very bearish. We'll see if Bitcoin is able to break this triple top. I don't know yet. Bitcoin has surprised me before. I think it has surprised all of us except for the true believers. The way I put it on Twitter is, imagine if Bill corners the oil market, and therefore people have to pay him for the oil because people need oil. But if Bill corners the Bitcoin market, what does Bill have? Or is it Bob? I don't know. Next slide. All of the second wind of QE quantitative easing has now been reversed. We're at the red line over here at $6.905 trillion in the balance sheet. That is just below this little thing here, this tangent point here. This was the first spurt of quantitative easing of QE in 2020 at the lockdowns that we all remember so fondly and lovingly. And then this is the second wind here that went for another 2 years around. And ended in early 2022. And from then on, we've been doing quantitative tightening, except for this little regional bank bailout over here. But we have basically reversed this whole thing, and we're headed further down. As you can see here, we're past May 2020, so things are going to get rough pretty soon. I hope it's going to be sooner than soon because I know I've been saying that for a while. But we're all going to look back at this, and soon is going to seem like a very short amount of time when we look at this in retrospect, though now it does feel like a long, annoying time. Gold open interest is down to about 457,000 contracts. This is around where we had a major low in July when we hit the same amount of contracts here. Open interest has fallen from about 600, just under 600,000 to now 457,000. It should head a little bit lower in the next few days as the first wave of deliveries gets cleared out of open interest. And if we are truly in a bull market, as I believe we are, I don't think open interest is going to fall much further than this, maybe slightly further, but not that much. So I think price has bottomed here at about 25.40 or whatever it was exactly over here. And now we're in either a holding pattern or we're moving higher. But either way, it's a good time to add to your stacks if that's what you are trying to do. You're not going to get much better prices than this, in my opinion. We're seeing the same thing in silver, where we see two bottoms happen at these open interest numbers, where the black line is at around 132,000 contracts. So we saw a major bottom over here in December of 2023, which took a while to get out of trading range, right, until March. So it took about 3 months, but we did not go substantially lower than this point over here, which suggests to me that these open interest numbers are telling us that we are at a major low in silver above $30 an ounce. That would have been, unimaginable just a few years ago when we were trying to get back to 30 after silver squeeze. And here we see another local bottom at these open interest numbers of 130,000. So I say we're safe in that we're not going to have much lower numbers in terms of price in silver, though that doesn't mean that we're headed up right now or imminently. We could be trading around these layers, these levels for another few weeks. Just as we saw here, this was 3 months. That was quite a long time. But we could head higher from here. Either way, these are the numbers that you're not going to get much better than if you're looking to add to your silver.
In today's news recap, silver gains as investors continued to assess the latest economic data. Silver prices gained 0.42%, bolstered by expectations of a Federal Reserve rate cut in December. Core PCE prices in October remained aligned with market expectations, maintaining hopes for a 25 basis points rate cut, which supports silver by reducing the opportunity cost of holding non-interest-bearing assets. Meanwhile, robust Q3 GDP growth, strong personal income and spending data, and historically low unemployment claims highlighted the resilience of the U.S. economy. Initial jobless claims remained steady at 213,000 for the week ending November 23rd, below market expectations, reinforcing the strength of the labor market. Globally, silver faces its fourth consecutive year of structural deficit, with a 4% decline expected in 2024, bringing the deficit to 182 million ounces. Despite a 1% increase in supply from key producers like Mexico, Chile, and the U.S., record industrial demand, recovery in jewelry consumption, and higher recycling will continue to strain availability. India's silver imports surged nearly tenfold to 4,554 metric tons in the first half of 2024, driven by solar panel and electronics demand, as well as investors seeking better returns compared to gold. Silver is showing signs of fresh buying, with open interest increasing by 11.4% to 25,927 contracts. Prices are finding support on the upside. Resistance is pegged, and a move above could see prices testing higher highs. Now we'll show you more clips, but first, check the pinned comment, especially if you're a stacker, as we have a massive Black Friday deal that every stacker should take advantage of, and hit the like and subscribe buttons so you do not miss out our recaps. Enjoy the episode.
Now we have a reverse repo update. This article is from Reuters. Some Fed policymakers open to lowering the overnight repo rate. The third paragraph here is what is important. So we're going to read that. But just as an introduction, they're lowering the overnight repo rate. They mean the reverse repo rate. By lowering that rate, they disincentivize banks to put money in the reverse repo facility, and they want it back in the banking system. They want to lower it by 5 basis points. And that should further disincentivize banks to put money in the RRP facility and should help zero it out. So it says here in the third paragraph here, Citi analyst at Citibank said that raising the idea in November to lower the reverse repo award rate suggests it could occur in December or January and would push more cash out of the reverse repo facility. So I think they're trying to squeeze the last dollars out of this thing. And I don't think they're aware of what might happen when it goes to zero, but they're going to find out pretty soon. So if we look at the reverse repos, this is the weekly movement in reverse repos. We are now at $197 billion as of Friday, the last day of November, and it's now December 1st. So on December 2nd, we're going to find out what the move into December this year is going to take away. Every time you move into a new month, there's a big plunge in RRPs that happens every month. So I highlighted the last 3 Decembers here, December 2021, December 2022, and December 2023, all December 1sts. In December 2021, we fell 90 billion. In December 2022, 65 billion. In December 2023, 119 billion, almost 120 billion. So if the average, I think, is about 92 billion, I did the math earlier, so 92 billion from 190 billion, will be about something around $100 billion come Monday or come the first week of December, and then $100 billion left. Hopefully it'll drain out by the end of the year, and by January 1st or 2nd, or whatever the first business day is in January, that should, for all intents and purposes, finally zero out the reverse repos, and we could have a banking crisis just in time for Trump to be inaugurated as the 47th president. Now we're looking at key Keynesian-style recession indicators. I found this one. I think it's from Bloomberg Intelligence. They're very intelligent over there. If you look at the red line, or is it the green line? I don't know what the hell it is, but it's not this. This one's blue. I can see blue. I don't know what color this is. It's the not blue line. I know that. You see here that it's at 2.9%. If you draw the line backward to the 2008 financial crisis, you see that we're above the rate that we were at in seriously delinquent loans. Seriously delinquent auto loans were above that by about 0.5%. And we could head into the next recession at any time now, and it's going to be made worse by a plumbing crisis, we all know. Now this is a chart from, I think it's Mish, and that's Mike Shedlock, and he measures inflation by 5 measures, and you can see, I don't know what's what here. This is all, I hate charts like this. I hate charts like this because I don't know what is what. But the orange thing is core CPI, but the rest all kind of looks like this. Oh, PCE appears to be this one. I don't know. Is that core PCE? Who knows? The point is here that these are all flatlining and starting to rise again. These 3, and this one's the same. So 4 out of the 5 indicators of inflation have bottomed out, it appears, and have been bottoming out for the last few months. If we move here to the core PCE, and this I can definitely see because it's all blue, we're starting to move higher on the core PCE, which actually is the Fed's preferred measure of inflation, preferred measure in quotes. This is what they look at when they're looking at inflation, as they call it. And we've been steadying for the past 2, 3, 4 months, maybe 5 months. I don't know exactly, but yeah, about half a year we've been studying. And this is the first major blip up in the core PCE read. This is for October, I think. And we're going to be heading higher on this. And you can see that we bottomed out higher than at any point, I think going back to like 1990 or something like that. Higher. This is higher than we were at prior to the 2008 financial crisis. So if inflation or core PCE inflation has bottomed out at these levels, we're headed for serious price increases in consumer prices very shortly.
That wraps up our deep dive into Rafi Farber's perspective on the ongoing liquidity crisis and his unwavering bullish stance on gold. Rafi's analysis highlights the growing pressure in financial markets and the role gold plays as the ultimate safe haven during times of systemic uncertainty. As liquidity dries up and central banks are cornered into increasingly drastic measures, do you agree with Rafi's outlook? Is gold the cornerstone of financial survival in the face of a liquidity crunch, or do you see other assets playing a bigger role? Let us know your thoughts in the comments below.